Hello and welcome. My name is Dr. Cheryl Dunn, and this video demonstration will show you how to make journal entries for a list of transactions for a company. The list of transactions, the first transaction that we're given is that PDE was incorporated on January 1st. And it says on that day, shares of capital stock were issued to investors for a total of $90,000 cash. Okay, so first we have to ask ourselves, is that an accounting transaction? Does it affect an asset, a liability, or equity accounts? And if the answer is yes, then we make a journal entry. In this case, it is an accounting transaction, and so I'm going to make my representation of a general journal here. Basically, I'm going to have a column for the date, a column for the account names, a column for the debit part of each entry, and a column for the credit part of each entry. And so for this entry, it happened on January 1st. So I'd put in my date of 1/1. And the account that's going to be debited is our cash because we are receiving cash. Therefore, we will debit cash for the $90,000. And the account that we will credit is our capital stock account. That is an owner's equity account that represents ownership in the corporation by the investors that now own those shares. And so that will be credited for the $90,000. Okay, so that's our first journal entry. Our second journal entry, our second transaction to evaluate, I should say, says PDE hired 2 employees that it agreed to pay every 2 weeks based on their hours worked. In this case, that's not an accounting transaction. It will eventually become accounting transactions as the employees work and they get paid for the work they do. But if all we've done is hire them right now, there's no asset, liability, or equity account that's affected by that. So we simply ignore that one. The next transaction says PDE rented a building from which to operate, signing a 3-year lease contract and paying $12,000 in cash for the first 6 months' rent. When we pay 6 months' rent at a time, depending on whether we make annual statements or we make monthly financial statements, we need to set that account up differently. We're going to assume that this company makes monthly financial statements. And so what they want to do when they pay that rent, and that happened on January 1st as well, is they want to debit an account called prepaid rent, meaning they paid rent that's going to last for more than one accounting period. So we're going to consider it an asset. And then once the rent is used up, once we occupy the space that we're renting in this building, then we will transfer that amount from that asset into expense. And so the amount here was $12,000. So we'll debit the prepaid rent asset for $12,000 and we'll credit cash because we're decreasing our cash balance. So there's our second journal entry. Then it says on January 4th, the company purchased equipment at a cost of $20,000 with a down payment of $5,000 and an agreement to pay the remainder within 60 days. It doesn't say they signed a note, and it doesn't say anything about interest being paid, and so we assume this is like an account payable. It's a short-term liability that doesn't bear any interest, and so this is happening on January 4th. First of all, we're going to put the equipment on our books as an asset. So we're going to debit equipment for the total purchase cost, which was $20,000. Okay, then our cash is going to decrease because we did have to pay some cash up front, and that's $5,000. And then the remaining is going to go to the accounts payable. As a credit, which increases the account payable account. Here's a good illustration of how you can't think of debits as increases and credits as decreases unless you're talking about asset accounts, because here we have a liability, we're crediting it and it increases. So with the cash, it's an asset, the credit decreases it. With the liability, the credit increases it. Overall, our debits and our credits equal out and everything stays in balance. Okay, our next journal entry happens on January 6th. It says P&E paid cash to buy supplies at a cost of $1,000. And that happened again on the 6th. Supplies is going to be considered an asset until the supplies are used up. Once the supplies are used up, we'll transfer them from supplies, the asset, to an account called supplies expense. Here they're an asset and we're going to credit cash because we paid cash for them. The supplies asset is increased, so we debit it for $1,000, and the cash asset is decreased, so we credit it for $1,000. So that is our fourth journal entry and the fifth transaction that we evaluated. Okay, the sixth transaction says on January 9th, P&E performed services for customers who paid $400 in cash. And so first of all, we ask, is that an accounting transaction? And if the company is performing services, then that means it's earning revenue. And the fact that they received cash definitely means it's an accounting transaction. So we write the date in. Receiving cash, we'll always look at the cash side first because that's almost always the easiest. I won't say always, but a lot of times. So we're going to debit the cash for the $400 that we received. And then what gets credited is the revenue, or you could call it service revenue. And that's going to be credited for $400. Okay, our next transaction, it says on January 14th, the company performed services for customers on account for $600. And the customers are expected to pay within 30 days. This is a transaction then where the company did the work, but they have not yet received the cash. And so instead of debiting cash, we're going to debit an account called accounts receivable. This is called selling on credit. And when we sell on credit, we don't get the cash right away. There's a timing difference. And so this asset accounts receivable really represents that timing difference. And it's the right to receive cash in the future from these customers for $600. We're still going to credit service revenue or revenue just like we did when we received cash. It's just a different kind of asset that we're recording. Okay, you can see that I erased some of the journal entries that I had already made for this demonstration, and that's to make room for some more. I left a couple of them here because later transactions are similar or relate to the same kind of thing as particularly this last one here, and so I didn't want to remove the reference to that, and we'll have room with what I have erased. So our next transaction says that P&E paid $5,500 in wages to the 2 employees that it had hired for their first 2 weeks of work. And so this is happening on January 15th. And so in this case we would debit an account called wages expense, or salaries and wages expense, or just salaries expense, depending on what the company decides to name it. They're going to debit that expense account for $5,500, and they're going to credit cash for the $5,500. Now notice if it had said that they calculated the amount of wages that they owe, but they're not going to pay it until next week, then instead of crediting cash, they would have credited wages payable. But in this case, it said they paid them for those wages, and so we debit the expense and we credit cash. Okay, the next transaction on January 21st, it says they performed some more services for customers on account, this time for $800. So we're going to do the same thing we did down here on the 14th. We're going to debit accounts receivable and credit service revenue for the $800. Finally, it says that on the 25th, the company received cash from customers for whom it had performed the services on January 14th. So on January 14th, remember that we made this entry. We debited accounts receivable and we credited service revenue. So now when we receive cash, the cash side is easy. We want to debit cash because we received cash for $350. But we don't want to credit service revenue again because we already credited service revenue on the 14th. If we credit service revenue again here, we're going to be double counting revenue. That's not allowed. That's really bad to do. So instead of crediting service revenue, remember that this accounts receivable was just a timing difference between receiving the cash and recording the revenue. So now that we've received some of that accounts receivable as cash, we don't have as much of a timing difference or as much of that asset that we call accounts receivable left. So instead of having $600 in receivable, we now only have $250 in receivable. So we're going to credit the accounts receivable for $350. And that's it for our list of transactions and making them into journal entries. Thank you for viewing this demonstration. I hope you found it helpful.